When you're buying a BRRRR property, many times they're not in financeable shape. That's how you're getting it so below market value. You're buying a property below market, you're increasing the value, you're utilizing the bank debt to give back all of your cash, and you're creating a 25% equity position. You're not gonna have a lot of maintenance expense because it's fully renovated, but your potential rent tenants are gonna fall in love with it, right? People wanna live in nice places. I took my equity and then I traded up, and that is the beautiful thing about BRRRRs. They can hyper explode your portfolio. So before we dig into how to underwrite your next BRRRR property, what is a BRRRR property anyways? A BRRRR property is when you buy a property, you renovate it, you rent it out, then you refinance it with a new income in the property, and then you repeat the process. The benefit of a BRRRR property for investors, especially when you're getting started, this is how I got started in my real estate investing career about 18 years ago. You can purchase a property, increase the value by doing a rehab plan, and then utilize bank debt and leverage to refinance all of your cash back to you. And as an investor, that is an essential piece of our puzzle as we're trying to build out our portfolio. The more cash that comes back to us allows us to purchase again and keep growing, hence the repeat. So there's two main components in the BRRRR strategy that are essential for you to execute on. The first is you need to make sure that your total basis for the property is below a 75% loan to value. That means your purchase price, your renovation cost, and all of your debt costs need to add up to the 75% loan to value. That means that your loan balance or your total cost is at 75% of the new appraised value. On occasion, investors can go all the way up to 80%, but you need to verify that with your local mortgage broker. Not every borrower can qualify for an 80% loan to value. So again, talk to your mortgage professional. You want to know what the max loan to value that you can get. It is really important as you're looking at these properties, whether your basis is going to be 75% or 80%. The higher the loan to value that you can achieve on your refinance, the more buffer you have for the purchase price, rehab, and soft costs. So speak with your mortgage professional, get qualified, and find out your loan to value. The second main component when you're buying a BRRRR property is you want to make sure that it still cash flows or at least breaks even. One of the main benefits to the BRRRR properties is you're buying a property below market, you're increasing the value, you're utilizing the bank debt to give back all of your cash, and you're creating a 25% equity position. It's not just about getting your cash back, it's about building wealth. That 25% equity can go into play for investors across the board. You can take a HELOC out on those properties on occasion. You can sell those properties and 1031 exchange them and trade them for more doors. That's what I've done over the last 20 years. So the BRRRR strategy creates equity, and you can use that equity to expedite your growth. But at the same time, it's not just about the equity position. You want to make sure as you're looking at your BRRRR properties that they can pay for themselves at minimum. But you don't want to be stuck with a property that you have to service every month. If your rent income doesn't cover your mortgage costs, it can be more of a liability than an asset. So we're going to dive into the underwriting to make sure that your money doesn't get trapped in the next deal. So the first step I take when evaluating a BRRRR property is establishing the new fixed up value. The reason I like to start with comping a BRRRR property first is the comparable data is not only going to tell me what the potential value of the property is, the fixed up value that I'm able to lever with the bank up to 75%. It's also going to tell me what I need to do to upgrade these houses and dictate the rehab cost. The rehab cost is a huge component in your BRRRR property. It's not about just what you're paying for the property. Again, the concept of the BRRRR is to purchase the property, reclaim all of your down payment and all your cash back, but you have to be below that 75%. You could be buying a cheapest property in the world, but if the rehab expense is too high, you still might have to leave money in the deal. So starting backwards with the comps are going to start painting the picture for me as I'm looking at a potential investment. When comping a BRRRR property, I always like to pull 3 sold comps and 2 pending comps so I can evaluate the property correctly. I don't like to use less than 5 comps because appraisers are going to be using the same amount of data. If you're using just 1 or 2 comparables for your next BRRRR property, it can be subject to opinion. That appraiser might find 3 other comparables that might not be as high as yours, and it could bring your value down. Grabbing comparables that are of the same style are also going to help you ensure that value is not going to move much. Now, in many neighborhoods, there's a mixture of houses. There could be ramblers, there could be tri-levels, there could be daylight basements, appraisers are going to appraise those all differently. If we can't find comps that are the same style, a Rambler for a Rambler, we're going to go for properties that are all above grade. On a Rambler, 2,000 square feet, that's 2,000 square feet above grade. We're going to look for two-story houses or tri-level houses that have no below grade square footage so the appraiser can count the same finished square footage. So if you can't get that model match comp, look for the same above ground square footage or below ground square footage splits. It will help with the evaluation. Location. When we're comping these properties, we try to stay within a quarter to half-mile radius for metro in-city properties. We do that because that's what appraisers typically do. Most appraisers, when they're looking at your property, if you're in a metro area, are going to try to stay within a quarter-mile radius. Now, if there isn't a bunch of data points inside that radius, then they're going to go out to a half mile, and then they're going to expand out from there. Typically, an appraiser is going to go further out rather than further back in time. Follow the same rules appraisers do when you're pulling your comps. That's going to really help you iron out that value. Again, you don't want to break appraisers' rules because they won't do that when they're doing their eval. It could substantially throw your values off. And use recent sales. The only comparables that we use for a BRRRR property are within the last 6 months. That's what appraisers use. So you want to use the same methodology. So when you're evaluating your BRRRR property, keep your comparable data tight. You don't want it to be loose. You don't want it to be far out. You don't want to be outside the ranges of what appraisers do because they're going to have a hard time explaining it to the bank to get you that loan to value. And as I'm pulling these comparables, I'm documenting what needs to be done. An appraiser is not going to give me the same value if I don't have the same upgrades. It is essential that as you're pulling these comps, you listing out what these subject properties have. If the house has new windows, you need to install new windows. If it has new kitchens, install new kitchens. If the comp has an additional bath, you need to work it into your budget. Again, your rehab cost is a huge component in this BRRRR property. It's one of 3 major costs, right? Purchase price, rehab, and your debt costs. So take the time as you're looking through your comparables to document those upgrades. If you are $10,000 to $20,000 off on your rehab budget and you're maxed out at your 75% loan to value, you might have to leave that in the deal, which is going to jeopardize getting all your cash back out. The rehab amount is essential. So then document your upgrades, evaluate your rehab costs, create your budget, and work it into your numbers. After you've pulled your comparables and established that new future market value, you've created your scope of work from those comparables and created your budget. The last cost that you need to evaluate when underwriting your BRRRR is what is your soft and debt cost. When you're buying a BRRRR property, many times they're not in financeable shape. That's how you're getting it so below market value. If the property's in really good shape, it's gonna be hard to get it below that 75% loan to value. So typically investors purchase these properties with hard money or construction loans. These loans can cost anywhere between 10 and 12% and 1 and 2 points. The great thing about a hard money construction lender is they're able to finance all of your rehab costs into the loan. Construction lenders are essential when you're purchasing a BRRRR property. They help minimize the cash you have to invest in the property up front. So in a typical investment property, you're putting 20% down, and then you would have to come up with the rehab cost out of pocket, which can almost double the cash needed to purchase that property. With a construction lender, they're going to take your purchase price, add in your rehab cost, and then you're going to put 15 to 20% down of the total project, and they're going to finance you back all of your rehab costs. That's going to reduce the capital in your deal. So after I've completed my underwriting of establishing the market value, the rehab plan, and my debt cost, how do you calculate whether you have to leave money in the deal or not? So how you calculate whether you're going to have to leave money in the deal or not is you want to take the new future market value that you pulled from your comparables, times that by 75%. That's what your lender will take you up to. You then want to subtract your purchase price, subtract your rehab cost, subtract all your lending costs, and as long as all 3 of those costs are below the 75%, then you have no money left in the deal. And if it's even below the 75%, you could even get cash back out of the deal. That's what I call mega BRRRR. Not only did you buy a property, you left no money in the deal, it gave you more capital back to go buy again. And if you want to see a mega BRRRR deal, go to my YouTube channel and check out my case study. So after you've evaluated whether you have to leave cash in the deal or not, the next essential step in a BRRRR is to see if it will pay for itself. What is its cash flow position? So the first step in evaluating its cash flow position is to pull rent comparables. We've already gone through and established what the scope of work is, what our bedroom count and bathroom count after our renovation plan is. That's what we did in the first step of underwriting. That's also going to tell me, as I'm looking at my rent comparables, how nice is my property going to be. One great thing about BRRRR properties is you're buying a property below market value. It needs a lot of work. You're putting in a lot of the upfront cost and upgrades in the property that will get you a premium for your rents. You're fully updating this thing to increase the value and to lever to the 75%. The other major benefit is you're not going to have a lot of maintenance expense because it's fully renovated, but your potential rent tenants are going to fall in love with it, right? People want to live in nice places. How I pull rent comparables is I use the MLS. As a licensed real estate broker, I can pull up what has been advertised and rented for. Typically, the MLS is going to kind of show me the upper echelon of the rent prices because there's more broker costs, they're hiring them, they get a better dollar. That's going to kind of show me the top end. The next way I pull rent comparables, I talk to my property manager. What do they think they can rent it for? They know better than me. They're boots on the ground. They're doing it every day. They're going to tell me what will absorb it well. And if you don't have a real estate broker that can pull you your rent comps and you don't have a property manager because you self-manage, then there is countless amounts of websites out there that will calculate your projected rent costs for free or for paid. You want to look at what's going to give you the best data and works best for you. Once you've pulled your rent comparables to establish your monthly income, then you need to figure out, will it pay for itself or not? The first step, call your mortgage broker. You need to know what your interest rate is projected to be. If you don't know what your interest rate is, it's going to throw your cash flow way off. Don't guess. Get pre-qualified with a mortgage professional before you buy that BRRRR property. Huge mistake to just buy it with hard money and then go look for the permanent financing later. It can get you in trouble, your money can get trapped, and it can be detrimental to your investing career. So get pre-qualified. After I'm pre-qualified and I know what my interest rate is, I then can start to calculate my cash flow. So remember, with a BRRRR property, I'm trying to lever it all the way up to that 75% to maximize my cash position. I've already pulled the future market value of the properties when I did my comparables. I take that market value, I times it by 75%. That's the maximum loan amount that I'm going to be able to achieve. I then take that amount, put it into a mortgage calculator with the interest rate that was quoted to me from my mortgage professional, and that's going to tell me my monthly payment. You then need to calculate the rest of it, your expenses as a landlord. It's not just your mortgage cost. You need to calculate your monthly property tax, your monthly insurance cost. What are your utility bills? Are you bringing in a property manager? Vacancy rate. Typically, we add a 2 to 3% in our pro forma as a cost just for a vacancy rate. With our BRRRR properties, we actually put a 1% repairs and maintenance. With our older apartment buildings, we actually put 3 to 5% because they don't have as much money invested in them as we did on our BRRRR property. So judge your scope of work. The more work you do, lower your repairs and maintenance. The less work you do, I would increase it to offset any unexpected items. From there, you need to calculate your cash flow. What is your expected monthly rent? You then subtract your mortgage costs and subtract your other expenses we just covered, and there is your cash flow. For BRRRR properties, I highly suggest try to break even, right? You don't want to buy an asset that you have to pay for every month. That's really not an asset, it's a liability. So my goal as an investor when I'm looking at a BRRRR is to minimum break even, get all of my cash back out, and then create that 25% equity position. Even if the property's not cash flowing that well, I got all my money back out and I've created this equity position that I can trade later. So for my BRRRR properties that break even or just might cash flow a little bit, I'm really just banking equity. Typically, I sell those properties at about a year and a day. I don't really want a property that's only going to pay me a couple $100s a month. I also don't want to buy a rental property and have to leave 20% in. So the BRRRR property allows it for me to buy a property, get all of my cash back out, and then take that equity in a year and a day, 1031 exchange it as my down payment for the next property. And this is going to increase my cash flow by having more cash left in the deal. And it's none that came out of my bank account. I took my equity and then I traded up. And that is the beautiful thing about BRRRRs. They can hyper explode your portfolio. We started with 8 properties in 2008, 9, and 10. That's what we grew our rental portfolio to. By buying BRRRR properties, we have traded those up to nearly 1,000 doors. Utilizing that equity, building that equity is a real thing that you can exchange for serious wealth. So remember, you only have the equity if you evaluate it correctly. Pull your fixed up comparables, calculate all your costs, make sure you're below 75% loan to value, then you create your position that you can trade for later. Thank you everyone for watching our video on how to underwrite your next BRRRR property. If you enjoyed it, please like and subscribe below. And for more information on how to underwrite your next deal, check me out on Instagram at jdainflips or jamesdainard.com.